At the dawn of 20th century American finance operated without central authority oversight. Banks issued credit independently, often relying on trust reputation and fragile reserves nationwide. This decentralized system fueled rapid growth but magnified risk during periods of stress nationwide. Industrial expansion increased demand for capital, linking banks closely to speculative ventures. Railroads, trusts, and stock pools depended heavily on short-term credit arrangements. New York banks sat at center controlling reserves for entire national system. Seasonal cash demands regularly strained liquidity, especially during harvest and tax periods. No lender of last resort existed to stabilize panics when confidence suddenly collapsed. Financial stability depended on cooperation among private bankers rather than formal institutions. Clearing houses sometimes coordinated responses, but lacked authority to act decisively nationwide. Speculation intensified during early 1900s amid optimism and rising asset prices. Trust companies expanded rapidly, offering higher returns with lower reserve requirements. These trusts operated outside traditional banking regulations, attracting speculative deposits quickly. Their growth increased interconnectedness while reducing overall system resilience significantly nationwide. Any shock could propagate rapidly through correspondent banking relationships nationwide. In October 1907, such a shock materialized abruptly, unexpectedly. A failed attempt to corner copper markets triggered losses among speculators nationwide. Key financiers suffered reputational damage, undermining confidence across related institutions immediately. Depositors questioned solvency, withdrawing funds from exposed banks and trusts. Rumors spread faster than facts, amplifying fear throughout financial centers nationwide. Trust Company of America faced massive withdrawals despite holding substantial assets. Without central support, panic escalated as institutions hoarded cash defensively. Interbank lending froze, causing payment disruptions across commercial networks nationwide. Stock market plunged as brokers liquidated positions to meet margin calls. Prices fell not from fundamentals, but from forced selling pressures intensifying. Banks curtailed credit to preserve reserves, deepening economic contraction pressures. The panic revealed structural weaknesses long ignored during prosperous years. Private solutions emerged, led by influential financier J.P. Morgan. Morgan convened bankers coordinating liquidity support for threatened institutions. He evaluated balance sheets, deciding which firms deserved rescue assistance. This ad hoc authority substituted temporarily for absent central bank functions. Morgan organized pooling of funds, stabilizing trust companies selectively. The New York Stock Exchange required emergency loans to remain open. Morgan personally intervened, preventing closure that would worsen panic conditions. Despite efforts, regional banks still faced shortages due to reserve concentration. Currency scarcity forced issuance of clearinghouse certificates as temporary money. These certificates substituted cash, enabling transactions during acute shortages nationwide. Economic activity slowed as credit contraction spread beyond financial sector. Factories reduced output, workers faced layoffs and reduced wages. Public confidence in financial system eroded, demanding political response. Reformers on private bankers proved dangerous, undemocratic. The panic highlighted power concentration among financiers without public accountability. Congressional investigations examined causes, focusing on trust companies and speculation. Debate emerged over necessity of centralized monetary authority. European nations already operated central banks managing crises effectively. American exceptionalism resisted centralization, fearing political manipulation of money. However, practical necessity outweighed ideological resistance after panic experience. The Aldrich-Vreeland Act authorized emergency currency issuance temporarily. It also created National Monetary Commission to study reforms. Commission members traveled Europe analyzing central banking models. Senator Nelson Aldrich played leading role synthesizing findings. Behind closed doors, bankers collaborated drafting proposals for new system. Meetings at Jekyll Island refined framework balancing public-private control. Design aimed to stabilize markets while preserving banker influence significantly. The 1907 panic thus became catalyst rather than isolated accident. Crisis demonstrated need for institutionalized lender of last resort. Public memory of panic softened opposition to centralized authority gradually. By 1913, Congress passed Federal Reserve Act establishing system. The new institution promised elasticity, stability, and crisis prevention, yet its origins traced directly to panic dynamics and elite coordination. After the immediate panic subsided, attention shifted toward preventing recurrence of such crises. Policymakers recognized existing banking structure could not support modern industrial economy reliably. Fragmented reserves, seasonal liquidity shocks, and speculative excesses demanded systemic reform urgently. The Aldrich-Vreeland Act represented interim acknowledgement that emergency mechanisms were essential. This legislation allowed banks to issue temporary currency during severe financial stress. However, temporary fixes failed addressing underlying coordination and governance deficiencies permanently. The National Monetary Commission assumed responsibility for designing comprehensive monetary reform. Commission members included legislators, bankers, economists, and industry representatives with diverse perspectives. Their mandate involved studying domestic failures and foreign central banking systems comparatively. European models, particularly the Bank of England, influenced American reform discussions significantly. Germany, France, and Britain demonstrated centralized control could stabilize credit cycles effectively. Commission reports emphasized elastic currency lender of last resort functions and supervision. However, political resistance to centralized power remained strong within American discourse. Populists feared concentration of financial authority benefiting Wall Street elites exclusively. Progressives worried about private bankers controlling public monetary policy decisions. Thus, reform required careful framing to balance interests and assuage public concerns. Senator Aldrich advocated a central institution with strong private sector participation. He argued bankers possessed expertise necessary managing complex financial systems responsibly. Opponents countered bankers caused crises and should not govern monetary authority. This ideological tension shaped subsequent design compromises, deeply influencing final structure. Meanwhile, private bankers continued informal coordination, anticipating future regulatory frameworks. They understood centralized authority could protect system from destructive competition. Behind scenes, leading financiers collaborated drafting proposals, aligning with their interests. The secret meeting at Jekyll Island epitomized this collaboration among elites. Participants included representatives from major banks and financial institutions nationwide. They operated discreetly to avoid public backlash against perceived conspiracies. Their objective was crafting central bank acceptable politically yet effective operationally. The resulting plan proposed regional reserve banks overseen by central board. This structure diffused power geographically while retaining coordinated policy control. Private banks would own shares in regional banks, ensuring participation. Government-appointed board members provided veneer of public oversight legitimacy. Elastic currency issuance would respond to seasonal demand fluctuations automatically. Discount window facilities would supply liquidity during periods stressed nationwide. Open market operations would influence credit conditions through securities transactions. Although terminology evolved, functions mirrored European central banking practices closely. The plan emphasized stability, efficiency, and crisis prevention as primary goals. Critics argued private ownership compromised public interest, fundamentally undermining democracy. Supporters countered hybrid structure balanced expertise, accountability, and political independence. The panic of 1907 remained persuasive evidence, supporting reform necessity. Memories of frozen credit and economic hardship influenced legislators' votes strongly. Businesses, farmers, and workers favored stability over ideological purity increasingly. By 1913, political conditions aligned, enabling passage of Federal Reserve Act. President Woodrow Wilson supported reform, framing it as democratic compromise. The act established 12 regional Federal Reserve banks across nation. A Federal Reserve Board in Washington coordinated policy and oversight. Member banks were required to subscribe capital, integrating system participation. The new system aimed reducing reliance on private rescue operations. It institutionalized lender of last resort functions previously performed ad hoc. Initial years tested framework during minor panics and economic adjustments. While not eliminating cycles, it improved coordination and response capacity. Critically, the Fed centralized monetary power, altering the relationship between state markets. This shift redefined sovereignty over money credit and financial stability. The 1907 panic thus functioned as narrative justification for transformation. Crises legitimize reforms otherwise politically impossible during normal conditions. Understanding this pattern illuminates how systemic change often follows disruption. With the Federal Reserve established, attention turned toward its evolving role during crises. Early operations focused on discounting commercial paper, stabilizing seasonal liquidity demands. However, real tests arrived when global conflict and depression stressed monetary frameworks severely. World War I required massive financing, expanding balance sheets, and government coordination. The Fed supported war bonds, demonstrating integration with fiscal objectives rapidly. Post-war adjustments revealed limits of policy coordination amid speculative excesses. The 1920s credit boom tested restraint amid political and market pressures. Loose conditions fueled asset inflation, culminating in 1929 collapse. The Great Depression challenged assumptions underlying central banking effectiveness fundamentally. Despite existence of Fed banking failures cascaded, revealing governance shortcomings. Regional reserve banks acted inconsistently, delaying coordinated national responses critically. Monetary contraction deepened depression, amplifying unemployment and social distress nationwide. These failures prompted further reforms, expanding federal oversight authority significantly. Banking Act 1933 introduced deposit insurance separating commercial investment banking. The Federal Reserve gained clearer mandates supporting financial stability employment objectives. Yet centralization also concentrated power, raising democratic accountability concerns persistently. Over decades, the Fed evolved, adapting tools responding to new economic realities. Open market operations replaced discounting as primary policy mechanism gradually. Interest rate targeting became dominant, influencing investment consumption decisions economy-wide. Financial innovation introduced complexity, challenging regulatory frameworks continuously. The Panic of 1907 remained symbolic origin story for intervention. Each subsequent crisis reinforced belief centralized authority essential for stability. However, critics argue interventions encourage moral hazard, excessive risk-taking behavior. They contend safety nets socialize losses, privatizing gains, undermining market discipline. Supporters counter absence of intervention risks systemic collapse, harming society broadly. This debate persists, reflecting tension between stability and accountability trade-offs. Historical perspective reveals crises often justify expanding institutional authority repeatedly. Emergency measures normalized over time, embedding permanent structures inadvertently. The Fed's mandate expanded beyond crisis management into macroeconomic stewardship. Inflation targeting employment goals, financial stability coexist. Sometimes conflict policy decisions influence wealth distribution, asset prices, and political outcomes indirectly. Thus, central banking transcends technical function, shaping societal power dynamics. Understanding origins clarifies why institutions behave as they do today. The Panic of 1907 illustrates crisis as catalyst for consolidation. It demonstrates how fear accelerates acceptance of centralized solutions. Such patterns recur globally whenever systems approach breaking points. Studying them informs interpretation of contemporary policy debates. Modern markets remain sensitive to confidence, liquidity, and authority signals. Technology accelerates transmission, amplifying both panic and relief episodes. Therefore, institutional credibility remains cornerstone of financial stability frameworks. Yet credibility depends on transparency, consistency, and perceived fairness. Central banks walk a delicate line balancing independence with public trust demands. Missteps can reignite skepticism, fueling political backlash unpredictably. Thus, history offers caution against complacency regarding institutional legitimacy. The Fed's birth was pragmatic response, not inevitable destiny. Alternative paths existed reflecting different balances of power interests. Recognizing contingency empowers citizens, evaluating present proposals critically. Financial systems are designed shaped by choices, not natural laws. Crises expose weaknesses, offering opportunities for redesign, beneficial or exploitative. Informed publics can influence outcomes, demanding accountability safeguards. The story of 1907 remains relevant precisely for this reason. It reminds us emergencies compress debate, elevating expert authority quickly. Preparedness includes understanding mechanisms before crises strike again. Education reduces fear, enabling rational discourse during turbulent moments. This channel aims providing that historical context for modern understanding. If you value deep financial history analysis, subscribe for upcoming episodes. We will trace subsequent crises linking past decisions to present structures. Like, comment, and share to support continued research-driven storytelling.